All right, hello and welcome to another session of the My Solo 401k Financial, My Community daily webinar series. We're actually hosting our one of our weekly deep dive contribution sessions. So we're in the middle of contribution season. We're kicking it off with a deep dive contributions guide, specifically geared towards businesses that are taxed as S-corp-C-corps. Could be an LLC taxed as an S-corp or a C-corp. So let's get started. If you're on YouTube or if you are on any of the other social streams like LinkedIn, etc., you can post questions. Please please subscribe. As again, we're kicking off the contribution season, so there's going to be a lot more content like this, like really deep dive content like we're about to go through. So the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. As always, you can join us on our community. It's always free to join. All are welcome, not just for existing customers, but for really anyone. You can join us at mysolo401k.net/mycommunity. We do host webinars every day, twice per day. You can always find the schedule at mysolo401k.net/webinar. You can participate in forums 24/7 on the community. We have a library of videos and webinars. So there's a lot of great ways to learn and to share the knowledge. So today's topic is 2024 and 2025 solo 401k contributions. We really want to go through it A to Z. Again, this session is geared towards businesses that are taxed as an S-corp or a C-corp. Could be an LLC taxed as an S-corp or a C-corp. We will have here in the coming days, we're going to be having additional contribution guides that are geared towards different types of businesses, right? It could be a sole prop, a partnership, a single member LLC. We're also going to be having a lot of good content regarding mega Backdoor Roth. We're going to be having additional content on the magic number. In other words, how much income someone would need in order to justify contributions that would allow them to maximize contributions to the plan. So please subscribe to the YouTube and you'll get all the notifications so you can participate live, ask questions, etc. So to really go through it, we want to start out with the contribution limits. Then we want to go through scenarios and examples to really apply those limits to some practical examples to really understand it. We want to talk about how to use our online calendar. We want to talk about the deadlines, so all the mechanics, right? How to make contributions, how to report contributions, what is not a contribution. And then we've got some bonus content around the $1,500 solo 401k tax credit. So as always, please feel free to chat over questions or topics you want to discuss, because this is during our regular, one of our 2 daily sessions that we host. So if you got other questions or topics or questions around this topic, don't hesitate to chat that over too. We'll go through all the questions at the end. So as I mentioned, so we start out with contribution limits. So anytime you're talking about how much you can contribute to a solo 401k, it's good to recognize that there are some basic factors that will go into that calculation. Number one is your self-employment income. The way that I think about it is that a 401k is for people who work to be able to save for retirement. A solo 401k is for a self-employed person to be able to save for retirement. So the purpose is for someone to save their earned income. So in the context of a self-employed person, it's got to be earned self-employment income. So in the context, and we'll talk about what that is for a business tax as an S-corp or a C-corp in a moment. Additional factors are age, right? So once you're over a certain age, the rules allow you to make catch-up contributions. And we'll talk about how now there's even a super catch-up contribution if you're between age 60 to 63. Do you participate in another plan like a 401k through a day job? Okay, well, that could impact how much you can contribute to the solo 401k. And then the types of contributions. So solo 401k plans have the highest contribution limits for any defined contribution plan available to self-employed individuals. And that's because you can make all different types, right? You can make employee versus employer, right? In the words of the IRS, when you're self-employed, you're both the employee and the employer. So you can make both types. And then if you have a plan like ours that allows it, you can also make pre-tax, Roth, and even voluntary after-tax contributions. So let's start to dig into those different factors. So remember, first one is you can't save more than you earn. So what you earn for a solo 401k is your self-employment income. What that means for a business that's taxed as an S corporation, a C corporation, could be an LLC taxed as an S corp or a C corp. Your earned income is equal to your W-2 wages from that self-employed business. So you can't consider W-2 wages from other sources like a day job to justify contributions. You can't consider income that you earn as the owner or that you receive as the owner of the company, right? Like income that's unreported on a K-1 from the S-corp, for example. So W-2 wages is what you start with. So where exactly on the W-2 do you capture those W-2 wages, right? If you look at a W-2, there's multiple boxes. Well, specifically, you take box 1 of the W-2 plus any pre-tax elective deferrals not in box 1 and over in box 12. And we'll give you an example of what that means in a moment. But you take box 1 plus any pre-tax elective deferrals, so employee contributions not in box 1 and over in box 12, add them together, that's your W-2 wages. So in terms of how much you can contribute, right, it's going to be based on the contribution limits. And there's different considerations, right? So we're going to go through, okay, what are the limits? Then we're going to apply these limits to different scenarios to really illustrate it. So when you talk about the contribution limits, it's good to start out with the overall limit. So for example, for 2024, the overall limit is $69,000 plus an additional $7,500 that you can make as a catch-up contribution if you're age 50 or older. Now, this limit goes up as inflation goes up. So for 2025, the overall limit increased from 69 to 70,000. The catch-up contribution stayed the same if you're age 50 or older, but then a new super catch-up contribution was introduced if you're age 60 to 63. So instead of the $7,500 catch-up, if you're age 60 to 63, it's $11,250. So if you're age 60 to 63, you may be able to contribute up to $81,250 to your solo 401k for 2025. Now, to further understand those contribution limits, we have to recognize that there's different types of contributions that can be made to the solo 401k, right? You have, and then each of those different types will have their different limits, sublimits, you could think of them as. So the first type is the employee contribution bucket. So employee contributions can be contributed as pre-tax, can be contributed as Roth. They can even be contributed as voluntary after-tax. Now, pre-tax and Roth employee, they'll have the same sublimit. Voluntary after-tax has a different limit, and we'll explain more in a moment. Another category is employer contributions. So with Secure Act 2.0, you can now make employer contributions as Roth contributions. And we'll talk about some of the considerations there, but that could either go into the pre-tax bucket or the Roth bucket. In addition, as I've alluded to, you also have voluntary after-tax contributions. So this is how one makes mega backdoor Roth contributions. So we'll start to keep the fact that there's different buckets we can fill up in mind as we go through these contribution limits. So let's keep digging deeper. So let's first start out with that employee contribution bucket. What's the limit there? Well, it's employee contributions, by the way, are also referred to as salary deferrals. So remember the concept, right? You can't save more than you earn. So you always start out with your W-2 wages. So the employee contribution limit is going to be 100% of your W-2 wages from your self-employed business, dollar for dollar, up to $23,000 for 2024, plus an additional $7,500 if you're 50 or older. Now for 2025, you still start with the W-2 wages, but you can contribute more. It's going to be $23,500 instead of $23,000, plus an additional $7,500 if you're 50 or older, or an additional $11,250 if you're age 60 to 63. So for 2025, you may be able to contribute up to $31,000 if you're age 50 or older, or $34,750 if you're age 60 to 63. Now, this employee limit applies at the employee level. So that's why you need to reduce how much you can contribute to the solo 401k as an employee contribution by contributions made to another retirement plan, like a day job 401k plan. So there's a lot of individuals that might have a day job, might participate in their day job 401k, that might also have a side hustle for which they set up a solo 401k. So if they max out their contributions to their day job plan, can't make any more employee contributions to the solo 401k because that employee limit applies at the employee level. Now, that exception to the rule that you have to aggregate with contributions made to another plan doesn't apply if the other plan happens to be a 457 governmental plan. So in that case, contributions are not aggregated. So these employee contributions can be made as pre-tax contributions. They can be made as Roth contributions. So it's going to be that same limit, right? It's going to be 100% of the W-2 wages up to $23,000 for 2024, or an additional $7,500. Or for 2025, it goes up to $23,500, or an additional $7,500 if you're 50 or older, or an additional $11,250 if you're age 60 to 63. Now, if you decide to make employee contributions as Roth contributions, they need to be deposited into a separate sub-account for each participant. So if it's a husband and wife that are both working in the same self-employed business, they're both receiving their own earned self-employment income, like their own W-2 wages, and they're each making contributions to the plan, they're each going to have their own separate accounts. So you might have one Roth account for one spouse, another Roth account for the other spouse inside the 401k. So that's the employee contribution limit. Now let's talk about the employer contribution limit. So the employer contribution limit is a percentage of the self-employment compensation. So it's a percentage of the W-2 wages from the self-employed business. It's 25% of the W-2 wages. Now this goes back to, okay, what exactly are we talking about when we talk about the W-2? Because there's different boxes on that W-2. There's different amounts. So you take box 1 of the W-2 plus any pre-tax elected deferrals not in box 1 and over in box 12. Okay, let's give an example to illustrate that. Let's assume your wages are $100,000. Let's assume you're over 50 years of age. Let's assume you're making contributions for 2024, or let's say 2025. So you make $31,000 in pre-tax employee contributions. So that's reducing your taxable income. So that means that your box 1 is not going to be $100,000. It's going to be reduced by $31,000 because you made a pre-tax elective deferral. So that box 1 is going to be $69,000. And that $31,000 of pre-tax employee contributions are instead going to be reported over in box 12. So when we talk about 25% of your wages, you take $69,000 from box 1, $31,000 from box 12 equals $100,000 multiplied by 25%. $25,000 then is how much you can contribute. Now, unlike the employee limit that applies at the employee level, the employer contribution limit applies at the plan level, right? This is why employers don't have to ask their employees, did you make contributions to another plan through a different unrelated employer, right? So that employer limit applies at the employer level. So even though someone might have maxed out their contributions to another plan, like a day job plan, that's not going to prevent them from making employer contributions based on their self-employment compensation, so their W-2 wages from their business tax as an S-corp or a C-corp. An exception to that rule, though, is the 403B exception. So if contributions are made to a 403B, whether they're employee or employer, by the solo 401k participant, those 403B contributions, all types, together with any contributions they want to make to the solo 401k, the sum cannot exceed the overall limit. So you do have to aggregate if contributions are made to a 403B. Now, keep in mind that overall limit, right? So the total amount of contributions made to the plan, whether employee, employer, or voluntary after tax, can exceed the overall limit. Remember, that was what we talked about earlier, right? $69,000 for 2024, or an additional $7,500 if you're age 50 or older. For 2025, it goes up to $70,000, or an additional $7,500 if you're 50 or older, or all the way up to $81,250 for 2025 if you're age 60 to 63. So typically, these employer contributions are made as pre-tax contributions to reduce your taxable income. Secure Act 2.0, though, now allows employer contributions to be made as Roth contributions. In our experience, we have always had plans that allow for mega backdoor Roth contributions. So really, based on experience, based on our client feedback, that was really not much of an impact because our plans already allowed for mega backdoor Roth contributions. In other words, customers weren't choosing to make employer contributions as Roth contributions. So why might that be? Well, there's a couple of different factors. At the beginning, there was not a lot of clarity about how to report employer contributions. That's now been clarified. But along the lines of reporting, when you make an employer contribution as a Roth contribution, it's more complicated reporting. Whereas making contributions as after-tax contributions and then transferring to the Roth is more streamlined. So more streamlined reporting is one factor. Another factor is going to be it's easier to hit the maximum if your goal is to maximize the money going into a Roth account, you don't need as much self-employment income to hit the maximum. And that's because the voluntary after-tax contribution limit is 100% of the self-employment compensation, right? Dollar for dollar up to the limit. Whereas, as we saw, the employer contribution limit is a percentage. It's 25%. So the individual needs more income to justify the contribution that they want to make. So that's another reason that folks are choosing to make mega backdoor Roth contributions as opposed to making employer contributions as Roth contributions. From a deadline perspective, it's the same. In other words, even if somebody wants to set up a plan and make 2024 contributions now, here in 2025, they can still do it. You can still set up a plan here in 2025 and make 2024 contributions as long as the plan is set up in time to make employer or after-tax contributions by the business tax return deadline, including any timely filed extension. So you can still set up a plan for an S-corp or a C-corp and make employer after-tax contributions for 2024. So it's the same from a deadline perspective. Now, it's too late if your business is taxed as an S-corp or a C-corp to set up a plan now in 2025 and make employee contributions, but you could still set up a plan and make employer or after-tax contributions. Lastly, why would someone choose to make voluntary after-tax contributions as opposed to making employer contributions as Roth contributions? Well, they have more flexibility when it comes to those voluntary after-tax contributions. Specifically, the individual can transfer those voluntary after-tax solo 401k funds to a Roth IRA without needing to meet a triggering event. So the individuals can deposit into the voluntary after-tax solo 401k account and then transfer the funds out to a Roth IRA. Whereas if the individual makes employer contributions as Roth contributions and then subsequently wants to transfer those funds to a Roth IRA, they'd have to meet a triggering event, like being age 59 and a half or another triggering event. So additional flexibility with respect to those voluntary after-tax funds is another factor. Some of the FAQs when it comes to making employer contributions as Roth contributions, do I need to deposit those employer contributions made as Roth contributions in a separate account? No, they can be deposited into the same Roth account in which the individual may be making Roth employee contributions. What is the contribution limit? Well, again, it's that employer limit. Whether it's pre-tax or Roth, it's going to be 25% of the self-employment compensation, specifically 25% of the W-2 wages from the self-employed business. How do I report? So I alluded to the fact that there wasn't clarity when the rule first came out as far as how to report those employer contributions made as Roth contributions. The clarity came out about a year after the law was enacted. So per IRS Notice 2024-2, Roth employer contributions are reported as tax deductible on the employer's return. So the 1120 if the business is taxed as a C-corp, the 1120S if the business is taxed as an S-corp for the year for which the contributions are made. But then it's reported as taxable to the employee for which the contributions in the year for which the contributions are deposited. So if somebody sets up a solo 401k plan now, wishes to make employer contributions for 2024 by the business tax return deadline, including extension, those contributions are made for 2024. So it's going to reduce the taxable income in the employer's tax return for 2024, but then raise the employee's taxable income for 2025. So if it's deposited in 2025 for 2024, reduces the employer's tax return for 2024, but then so it's tax deductible on that return, but then it becomes taxable to the employee on the 2025 1040 via a 1099-R issued to that employee for the year of the deposit. So it becomes taxable via that 1099-R, because ultimately it's got to be taxable money since it's made as a Roth contribution. In other words, it's contributed on a post-tax basis. Okay, great. So now let's talk about the last bucket, which is the voluntary after-tax bucket. What is the contribution limit there? And keep in mind, voluntary after-tax contributions are how one makes mega backdoor Roth contributions. So the voluntary after-tax contribution limit is going to be the lesser of the self-employment compensation. Remember, that's W-2 wages from the self-employed business taxed as an S-corporation or a C-corporation, or the overall limit. So you can contribute, another way to say that is you can contribute 100% of your wages dollar for dollar up to the overall limit, $69,000 for 2024, $70,000 for 2025. So that's, again, why some folks are choosing to make, instead of making employer contributions as Roth contributions, they're making voluntary after-tax contributions because they don't need as much money to be able to hit the overall limit, so since they can contribute 100% dollar for dollar up to the limit. Now, you have to keep in mind that overall limit. So the sum of all the contributions made to the plan, whether employee, employer, or voluntary after-tax, can exceed that limit. Another consideration here is, what about the catch-up? So a catch-up contribution, right, that's $7,500 if you're age 50 or older, or $11,250 if you're age 60 to 63 for 2025. That catch-up contribution has to be made either as a pre-tax or a Roth contribution. In other words, elective deferral, an employee contribution. It doesn't go into the after-tax bucket. But when you're aggregating all your contributions to the plan, employee, employer, and after-tax, for purposes of determining whether or not you've met that voluntary after-tax limit, you can ignore those catch-up contributions made. So let's assume somebody is age 50 or older. They make a $7,500 pre-tax catch-up contribution to the pre-tax account, and they've made no other contributions to the plan. Let's assume it's for 2025, and they have at least $77,500 of W-2 wages. They're going to still be able to make a $70,000 after-tax contribution. So they're still in sum making $77,500 in contributions to the plan. It's just that catch-up contribution has to be made either to the pre-tax account as a pre-tax employee contribution or as a Roth elective deferral, as a Roth employee contribution. It's not made as an after-tax. Now, like the employer contribution limit, the voluntary after-tax contribution limit is not impacted by contributions made to another plan unless the other plan is a 403B plan, in which case you got to aggregate all contributions made to the 403B, whether employee or employer, together with any contributions that the individual wants to make to the solo 401k, and the sum cannot exceed the overall limit. So even though somebody might have maxed out contributions to their day job plan, they're still going to be able to make voluntary after-tax contributions up to the limit, assuming they have the self-employment income to justify it. Now, like how Roth contributions need to be deposited into a separate account, likewise, voluntary after-tax contributions need to be deposited into a separate account. So that's why individuals will end up with 3 accounts: pre-tax, Roth, and after-tax. 6 accounts if there's, say, husband and wife that are both working in the same business, right? Pre-tax, Roth, and after-tax for each of them. Wonderful. So we made it through those contribution limits in terms of really understanding it, in terms of the rules. So now let's apply it to contribution scenarios. So we're going to start out with a base scenario. Then we're going to tweak the assumptions to really illustrate different points. So we're going to start out with the base scenario that the self-employed business is taxed as an S corporation. There's one participant who's under age 50 years of age who does not make contributions to another plan. Their goal is to first maximize pre-tax contributions and then make any additional contributions as Roth or voluntary after-tax contributions. Let's assume that they have at least $100,000 of W-2 wages. Let's also assume that all the employer contributions are made as pre-tax contributions, so not as Roth contributions. Let's clean that up a little bit. Okay, so here we go. So we're going to assume that all employer contributions made as pre-tax contributions. Now let's start to go through the different buckets. So with this base scenario contribution limit scenario, how much can they contribute to each bucket based on the $100,000 of W-2 wages? Well, for 2024, remember they want to first maximize the money going into the pre-tax account. So they can contribute 100% of their wages up to $23,000 for 2024 as an employee pre-tax contribution. Then they can move on to the employer contribution bucket and put another $25,000 into that same pre-tax account. So they got $48,000 in that pre-tax account. Now they can do the difference up to $69,000 as a voluntary after-tax, then move those funds from the after-tax account over to the Roth account. So at the end of the day, they have $48,000 in their pre-tax account, $21,000 in their Roth account. Now let's assume this was the same scenario, but instead for 2025. So now they can contribute $23,500 to their pre-tax account as an employee, $25,000 as an employer, and then the difference up to $70,000 as an after-tax. So now they have $48,500 in their pre-tax account between employee and employer, $21,500 in their Roth account. So they would have first deposited to the after-tax, then moved it to the Roth. Now let's change the scenario. So instead of $100,000 of W-2 wages, let's assume they have $50,000. How does that impact how much they can contribute? Well, it's not going to impact the employee limit, right? Because it's still 100% of those wages up to $23,000 for 2024, $23,500 for 2025. It does impact the employer limit, right? Because that's 25% of their wages. So instead of 100,000, now it's 25% of 50,000. So that's 12,500. And then it does impact their after-tax bucket, right? Because you can't save more than you earn. So the total amount of contributions made to the plan cannot exceed 50,000 because that's what their wages are. So that's going to leave them with 14,500 for 2024, 14,000 for 2025. So now let's go back to the base. Let's assume they're back to making $100,000 of W-2 wages. But here, let's assume that they max out contributions to another plan, like a day job plan. 23,000 to the day job plan for 2024, 23,500 to the day job plan for 2025. So they've already maxed out their employee contributions because, again, that employee contribution limit applies at the employee level. So they can't make any more employee contributions to the solo 401k. Their employer contribution limit, though, is not impacted by those contributions made to the day job plan. So they're still going to be able to make 25% or $25,000 to the pre-tax bucket. Remember here, they want to first maximize the pre-tax benefit and then make whatever else they can as a Roth or a voluntary after-tax. Well, this is a great example as it illustrates how that voluntary after-tax limit is not reduced by contributions made to another plan, like a day job plan. So now they're going to be able to go up to $69,000 for 2024 as an after-tax, so an additional $44,000 for 2025, an additional $45,000 to take them up to $70,000. And then they can move those amounts over to the Roth. So for 2025, for example, they'd end up with $25,000 in their pre-tax account, $45,000 in their Roth account. Okay, now let's go back to the base. Here, again, they're not making contributions to another plan, $100,000 of wages, still under 50 years of age. Their goal, though, now is to just maximize Roth and or after-tax contributions. So they're not interested in pre-tax contributions. So now they're still going to make that same employee contribution amount, but instead of depositing to the pre-tax account, they'll put it directly to the Roth. So for 2024, 100% of the wages up to 23,000. Again, they're not making contributions to another plan like a day job plan. They're going to skip the employer contributions because we're going to assume those are made as a pre-tax contribution, and they'll just make the difference up to the overall limit as an after-tax and then move it to the Roth. So for 2024, they end up with $69,000 in their Roth account. For 2025, they'll make a $23,500 employee contribution as a Roth contribution. Then they'll do the difference up to $70,000, so another $46,500. First deposit it to the after tax, then move it to the Roth. So that again, they'll still end up with that $70,000 in their Roth account for 2025. So now let's go back to the base. So here we're back to assuming they first want to maximize pre-tax, then Roth or after tax. Still under 50, they'll make contributions to another plan like a day job plan, $100,000 of W-2 wages. But here we're going to tweak it and assume that there's two participants. Let's say it's a husband and wife that are both working in the same business. So here, really the limits don't change from our first scenario. What we want to illustrate, though, is that it's for each person. So if each person is making $100,000 of W-2 wages from the self-employed business, and each person has that same scenario, right? Each person's under 50. Each person doesn't want to make contributions to doesn't make contributions to another plan like a day job plan. Then each person's going to be able to make these contributions to their separate accounts. Okay, now let's go back to the base, back to one person, but now we're going to change their age. Let's assume they're now 50 or older. So how do the contribution limits change? Well, they're now going to be able to make the catch-up contribution, right? And again, this person has $100,000 of W-2 wages. So this is a couple points to illustrate. One is the catch-up contribution. So they're going to be able to put that catch-up contribution as a pre-tax employee contribution. Because remember, we're still assuming they want to first maximize pre-tax. So for 2025, that's an additional $7,500. For 2024, that's an additional $7,500. For 2025, if they're age 50 or older, it's still another $7,500. But if they're age 60 to 63, instead of $7,500, they can do $11,250. The other point to illustrate here is the after-tax bucket is not changing, right? So even though they're over age 50 or older, they're not going to be able to make additional contributions to the after-tax bucket because instead those catch-up contributions are made as elective deferrals. They're made as employee contributions. But the after-tax limit is also not reduced by those contributions. So net, they're still able to make those higher contribution amounts, right? Like let's assume they're age 51 for 2025. They're still, if you add up all these contributions, going to end up contributing $70,000 or $77,500. So that's the other point we want to illustrate with this example. So now let's go back to the base. Just one person under age 50, they max out contributions to another plan like a day job plan. They do have $100,000 of W-2 wages from their self-employed business. They're not interested in making pre-tax contributions. They just want to make Roth or after-tax contributions. So in that case, they're not going to be able to make any employee contributions to the plan because they already maxed out to their day job plan. They're not interested in making employer pre-tax contributions because remember, they just want to maximize Roth or after-tax. So that means they'll just contribute 100% of their compensation up to the overall limit. So their compensation is over the overall limit. So that means they'll be able to contribute $69,000 for 2024, $70,000 for 2025. That'll first go into an after-tax account and then be moved over to the Roth. So at the end of the day, they're going to have $70,000 in their Roth solo 401k for 2025, $69,000 for 2024. Now let's go back to the base and we'll tweak it. So now they're back to being over age 50. They max out contributions to their day job plan. So now they're contributing more, right? $30,500 for 2024, $31,000 for 2025 to that day job plan. So they're also contributing the catch up to their day job plan. Here, their goal is to maximize Roth and or voluntary after tax. So they're not interested in pre-tax. So they've already hit their maximum employee contribution limit to the day job plan, not interested in making pre-tax employer contributions. So they're able to maximize that voluntary after-tax contribution. So this is another good illustration about how the catch-up contribution doesn't apply to the after-tax. And since this person already made their catch-up contribution to their day job plan, they're not going to be able to make any more catch-up contributions to the solo 401k. So now let's go back to the base. Now we're back to 2 participants. Each person's maxing out to their day job plan. Each person is only interested in making Roth or voluntary after-tax contribution. Each person has at least $100,000. So again, this is a good illustration about how the limits apply at the person level, at the participant level. So in this scenario, since we're assuming each person's in the same scenario, right? Each person has the same amount of wages, same age, etc. Since each person's already maximized contributions to their day job plan, can't make any employee contributions to the solo 401k. They're not interested in making employer pre-tax contributions because they're only interested in making Roth and after-tax. So each person will be able to contribute up to the overall limit as a voluntary after-tax contribution and then move those funds to their Roth solo 401k. So for example, for 2024, each person would end up with $69,000 in their Roth solo 401k. For 2025, each person would end up with $70,000 in their Roth solo 401k. So that takes us through the contribution scenarios. We want to highlight some resource here, which is our calculator. If you go to our website, mysolo401k.net, then click on Learn, then click on Online Tools, you can easily find the link to the calculator. You can see you'll have the option to enter an age, the type of business, the compensation. Here you would enter the W-2 wages. Remember, that's box 1 of the W-2 plus any pre-tax elective deferrals not in box 1. Now, the calculator doesn't contemplate a scenario where someone has a day job. It would also need to be modified for after-tax contributions, but it's a good resource to show you at least the employee contribution limit as well as the employer contribution limit. It also contrasts with other types of plans available to self-employed individuals, like a SEP IRA, for example. So it's a good resource there, so we wanted to highlight it. So now let's start to go through the mechanics, right? So we talked about the limits and applied it to different scenarios. How do I actually contribute this money to my solo 401k? Well, the contributions can be made by check. Electronic transfer is also totally acceptable from a solo 401k perspective. Now, the process to make electronic deposits is going to vary depending on the financial institution. So we are neutral as far as where the accounts are at. But at the same time, we're very hands-on in helping customers open up accounts at the bank or brokerage of choice. In terms of brokerages, Fidelity is definitely the top option. Schwab is number 2. Fidelity has the most options in terms of making contributions. So they're more flexible when it comes to electronic deposits. They have integrations with payroll providers, etc. So each participant will deposit his or her contributions into separate sub-accounts. We've talked about how you've got different accounts if it's pre-tax versus Roth versus after-tax. And again, we're very hands-on in helping set up those different accounts. Those contributions can be made in one lump sum or a series of contributions, so they don't necessarily have to be made every payroll or every paycheck. From a solo 401k perspective, it's definitely acceptable to transfer the funds from a personal account or a business account. What's more important from a solo 401k perspective is that the contributions are within the limits, they're made by the deadline, etc. So what is the deadline? Well, the deadline is the business tax return deadline. This is clear based on IRS publication 560. So for an S-corp, that's March 15th or September 15th if a timely extension is filed. For C-corp, that's April 15th or October 15th if a timely C-corp tax extension return is filed. So this is a good chart as it just explains or it illustrates how the deadline ties to how the self-employed business is taxed. So those are the deadlines for 2024, for 2025. You can see it's the same pattern. Now, how do I report contributions? Well, it depends on the different contributions that we're making. So let's go through the different types and we can see how they're reported. So in terms of employee contributions, those are not reported in box 1 of the W-2, but instead reported over in box 12 using code D and then check retirement plan field in box 13. A Roth employee contribution it's not going to reduce box one, right? Because it's not made on a pre-tax basis, right? It's not tax deductible, but it's still reportable on the W-2 per the W-2 instructions. Specifically, it's reported over in box 12 of the W-2, but instead of code D, you'd use code AA. And then again, likewise, check retirement plan in the retirement plan field in box 13. Voluntary after-tax contributions, likewise, are not going to reduce the taxable income, so it's not going to reduce the amount reported over in box 1. And unlike the Roth employee contribution, it can be reported on the W-2, but per those W-2 instructions, reporting voluntary after-tax contributions is optional. Now, if the individual chooses to report those, it may be reported on box 14 of the W-2, but again, per the W-2 instructions, reporting those voluntary after-tax contributions on the W-2 is optional. Now, employer contributions, whether they're pre-tax or Roth, those are going to be reported on the employer's return. Remember, we talked about how the IRS clarified that even if you make employer contributions as Roth contributions, so they're ultimately made on a post-tax basis, it's still going to be tax deductible on the employer's return for the year for which the contribution is made, then taxable to the employee for the year in which the contribution is deposited via Form 1099-R. So in either case, those employer contributions, whether pre-tax or Roth, are going to be reported on the employer's return. So for an S-corp, it goes on line 17 of Form 1120-S, whereas for a C-corp, those employer contributions are reported on line 23 of the Form 1120. Now, what about matching contributions? A common question, right? A lot of folks, their experience with a 401k generally might come from the corporate world, right? Where they might have been receiving a matching contribution. So matching contributions only apply to full-time employer plans, not self-employed solo 401k plans, like plans that are for owner-only businesses. Solo 401k contributions only consist of employee and profit-sharing contributions. Keep in mind that a matching contribution is when the employer matches what the employee has contributed. Whereas when you make employer contributions to the solo 401k, there's no prerequisite that you first made an employee contribution, right? Remember the scenarios where someone's maxed out contributions to their day job plan, so they're not able to make employee contributions to the solo 401k? Well, that's great that it's not a match because, again, there's no prerequisite that employee contribution was made. So profit contributions can be made to the solo 401k, even if no employee contributions are made to the solo 401k. What is not a contribution, right? That's another common question, right? Because money's being deposited into your solo 401k account. Does that count as a contribution? Does that reduce how much I can contribute to the solo 401k? Well, hopefully, if you're trying to maximize contributions, you don't want it to count as a contribution because that allows you to further, still meet your maximums. So amounts rolled over from an existing retirement account, like a former employer plan or a non-Roth IRA, those don't count as a contribution. Earnings from your solo 401k investment, right? One of the top reasons a customer set up accounts with us is the ability to invest in alternative investments. So it could be rents, right? Collected from real estate. Those earnings from your investment, they don't count as contributions. Amount converted within the solo 401k. So for example, if you're converting funds from a pre-tax account to a Roth account, that doesn't count as a Roth contribution. Or a voluntary after-tax account to a Roth account, that doesn't count as a solo 401k contribution. And then lastly, solo 401k participant loans. Another top use case is the ability to take a loan from your solo 401k. That means you got to pay back the loan to your solo 401k. So you're depositing money into your solo 401k. Those deposits of repayment of solo 401k loans do not count as a solo 401k contribution. So it doesn't reduce how much the individual can contribute to the solo 401k. As I mentioned, some bonus content. So our plan qualifies for a $1,500 tax credit. So under the Secure Act, a number of tax credits were introduced to encourage small businesses to set up solo 401k plans. Now, one of those tax credits is the startup cost credit, which is not available to a solo 401k because it requires that the business have non-owner employees, which of course a solo 401k is only for an owner-only business. But there's also the automatic participation credit or the automatic enrollment credits. Comes under different names. So a owner-only business that sets up a plan that includes that automatic participation feature is eligible for that credit, specifically $500 per year for 3 consecutive years for a total of $1,500. It's not based on the actual cost to set up and maintain the plan. It can be for both new plans and even existing solo 401k plans that are upgraded to our plan to include the automatic participation feature. That self-employed business would likewise be eligible to start claiming the credit. So if someone signs up for a plan here in 2025, they're going to be able to start claiming the credits when they file their 2025 tax returns, $500 per year for 3 consecutive years for a total of $1,500. If someone converts an existing solo 401k plan in 2025, they would be eligible to start claiming those credits when they file their 2025 tax return. And then again for 2 more years, as long as they maintain the plan for a total of $1,500. So it has a tremendous impact on the cost, right? Our fees are $650 is the initial cost, which includes the $525 establishment fee plus the first $125 annual fee. So in that first year, our cost is going to be $150. For the second and third year, the value of that credit is actually going to exceed our cost, right? Because in the second and third year, our annual fee is only $125, but the credit is $500. Ultimately, those credits are going to cover our fees for more than 7 years. This is a tax credit, not a tax deduction. So with the tax deduction, the individual is reducing their taxable income upon which their tax is calculated. Whereas with the tax credit, the individual is able to get a dollar for dollar reduction in their tax liability. So it's much more powerful in that regard. So eligibility, again, is having a plan like ours that includes that automatic contribution feature. What is the automatic contribution feature? It sets a default 3% contribution percentage, but the solo 401k participant, as the participant in the plan, has the right to opt out of that default 3% contribution amount. And exercising the right to opt out of the default contribution amount doesn't mean that the plan is not eligible to claim the credit. So opting out simply means that now the solo 401k participant can make contributions in whichever schedule or amount they prefer, obviously subject to the limits and the deadlines. Again, if you have an existing solo 401k plan, it could be upgraded to our plan, and then the self-employed person could start claiming the credits. We put together a deep dive webinar that we hosted with an IRS enrolled agent that goes through step by step what's needed to claim the credit. So specifically, it's done through filing Form 8881. So we were the first major provider to offer the plans that make the self-employed business eligible to claim the credit. We did that in coordination or at the same time as the form that's used to claim the credit was updated. So that Form 8881 was updated at the end of December 2023, and that's when we launched and made the update available for all new plans going forward, whether it's brand new solo 401k plans or pre-existing solo 401ks that were upgraded to our plan. So Lindsay's self-employed. She has a solo 401k plan. So as long as she updates her plan by the end of the year, so here it should say December 31st, 2025, she'd be able to start claiming the credit when she files her 2025 taxes, and then again for 2 more years. Whereas if Brad signs up for a solo 401k by the end of December 31st, 2025, he will be able to start claiming the credit when he files his 2025 taxes, and then again for 2 more years. So that takes us through the end of the content. Thank you so much for your good participation. Please like, please subscribe, please join us. We go live twice a day at mysolo401k.net/webinar. You can find the schedule. We're there 24/7 on our forums. If you just go to mysolo401k.net/my-community, you can find our forums. So there's a lot of great ways to participate, to share the knowledge, to learn, etc. So let's go to the questions now. Thank you so much for bringing the questions. We'll get to the beginning in case we got to reference any of these slides here. If you have an S-corp and established a plan by December 31st, can you simply opt to do only employer contributions by September 15th with proper extensions? In other words, 25% of the W-2 wages towards employer contributions without making any employee contributions? Absolutely. There's no requirement to make employee or after tax. The individual can just make employer contributions. Can I make contributions for my solo 401k now for 2025? Most certainly. You don't have to wait. You just want to be confident and certain that you have the W-2 wages or other self-employment income to justify those contributions so you don't end up in an excess contribution scenario. What is the maximum after-tax contribution that an employee can do? It's going to be 100% dollar for dollar of their self-employment compensation. For example, W-2 wages in the case of a business tax as an S-corp or a C-corp, all the way up to the overall limit, either $69,000 for 2024 or $70,000 for 2025. Keeping in mind that they have to make sure that the sum of all the contributions that they make to the solo 401k, right, whether employee, employer, or after tax, doesn't exceed that overall limit. Has anything changed in the rules from 2024 or 2025 except the limit? Well, no, just other than the super catch up, which is just another way of saying the limit changed, but really just the limits changed. So remember that super catch up is if you're age 60 to 63. Now, instead of $7,500 as your catch up, it's now $11,250 for 2025. As an S-corp owner, my wife and I have a solo 401k. How can we transfer the money to a 401k? Because the payroll company doesn't do the deposit on the 401k account. Well, there's no requirement to make contributions through the payroll company. So the individual can make contributions directly from the from the business or the personal account. Now, if it's going to be reported on W-2 and the payroll company is issuing that W-2, let's say it's an employee contribution, pre-tax or Roth, the individual can just simply let the payroll company know that they made that contribution so that can be tracked and reported on the W-2. Now, with that stated, many of these payroll companies can transfer money electronically. So it can go electronically, right, to the bank account or the brokerage account, assuming that bank or brokerage account can receive that electronic deposit. And then also keep in mind that the top brokerage option that customers are choosing to open up their accounts at is Fidelity. And they have built a number of payroll integrations, right? Like with Gusto, ADP, Paychex, Rippling, where funds can be automatically transferred through the payroll company to the brokerage account that's set up at Fidelity. It's not only with us. We were just the first major provider to offer it. Then others have followed, but you have to have a plan like ours that includes the automatic contribution feature. It's specifically called the EACA feature. And then on top of that, there are notices, forms. So it's not just a matter of updating the documents. You also have to have been provided certain notices and forms. And so as part of our packet of documents that we prepare, we of course prepare all those notices and forms, so the business is eligible to claim the credit. What amounts do you have to deduct from wages when calculating the possible amount someone can contribute the maximum as an employee contribution? For example, if you pay yourself $23,000 in wages, you will not be able to contribute $23,000 to the solo 401k as a deferral because employee is responsible for 1/2 of FICA. Well, as a matter of fact, no. So when someone determines how much they can contribute, they don't have to reduce their W-2 wages by the self-employment tax. So as long as they have at least $23,000 in box 1 of their W-2 and they didn't make contributions to another plan like a day job plan, they're going to be able to make those $23,000 in contributions to the solo 401k. Also keep in mind that making contributions also doesn't reduce your obligation to pay self-employment tax. So making solo 401k contributions doesn't reduce the obligation to pay self-employment tax, but one also doesn't have to reduce those W-2 wages by the self-employment tax before they determine how much they can contribute. In other words, you don't have to gross up your wages to justify the contribution. If one set up a solo 401k himself or herself on Fidelity, could she get the tax credit? No, because Fidelity doesn't support it. None of the major brokerage firms do. They don't provide the notices, the forms, etc. If you go to mysolo401k.net / thank you so much for that positive feedback. If you go to mysolo401k.net/support and then follow the links, you'll be able to start the process to get your plan updated. Thank you so much. I'm doing my first mega backdoor Roth at Fidelity. Can I just transfer from my Fidelity taxable account to my post-tax part of the solo 401k to the $69,000 limit, or do I have to call Fidelity by phone? So you typically have to call Fidelity, but if you call that investment only team, so if you Google Fidelity investment only, you'll be able to easily find their phone number, and then they'll be able to walk you through it over the phone, the process to transfer from a non-retirement account to the after-tax account that was set up for your solo 401k. So investment only is a type of account that is set up at Fidelity. So they have a team over there that supports those accounts. So we charge $650, which includes the $525 establishment fee plus the first $125 annual fee. Starting 12 months later, we charge our $125 annual fee. So January of next year, for example, if someone signs up now, that's going to be whether you're upgrading a basic plan, say a Fidelity to our plan, or starting a new plan with us. Keep in mind that setting up our plan or upgrading a basic plan to our plan will make the self-employed business eligible to claim $1,500 in solo 401k tax credits, which is going to more than cover our fees for the first 7 years. I also have a Roth IRA at Fidelity. Can I then transfer online from the post-tax? Yes, you can then transfer from the after-tax solo 401k account to the Roth account. No, if you transfer to the Roth solo 401k, then you'd have to meet a triggering event before you could transfer out of the Roth solo 401k to the Roth IRA. So if the goal is to have the funds those after-tax funds end up in a Roth IRA, the process would be to first deposit to the after-tax and then transfer directly to the Roth IRA. And then let us know about that after-tax to Roth IRA transfer so we can capture the information that's needed to prepare the required 1099-R, because that is reportable. Thank you so much for the great participation. Please continue to participate. You can join us every day at mysolo401k.net/my community. We have forums. We have a library of webinars. Come to our webinars at mysolo401k.net/webinar. It's always free to join. All are welcome. If you go to that webinar link, you'll find the schedule. As an addition to my prior question on $23,000 in wages, if you do $23,000 employee deferral, you cannot then do right, because the total amount of contributions cannot exceed the lesser of self-employment compensation or the overall limit. Can't save more than you earn. All right, we'll give it another minute or so to see if there are any more questions. Thank you for the great participation. Thank you. Awesome. Thank you. Thank you. Please like, please subscribe. Like I said, we're kicking off the contribution season. So we'll be back with lots more of these deep dive sessions, plus the magic number, plus mega backdoor Roth. Does the transfer from the post-tax solo 401k to the Roth have to be done before the tax day? There's no deadline to transfer the money from the after-tax to the Roth solo 401k or Roth IRA. The deadline is to deposit the money into the after-tax solo 401k account. All right, you guys have been awesome. Thank you so much. We really appreciate the chance to discuss these topics. Of course, we welcome the opportunity. So thank you so much, everybody. Take care.